That was certainly an interesting week that gives us something to think about and a reason to watch markets through the holiday as equities got hit. S&Ps broke that 6 handle, and we saw a couple weeks of deterioration outside of big tech lead to a full unwind of the post-election pop. So a few things that I learned here and a few important charts. The risk radar as we close out the week obviously has some major changes. The biggest one being on the macro with bond yields breaking back out and the dollar finding support and running to. I talked about the dollar chart at the top of the show where the weekly shows we are establishing support at earlier highs from this year and the highs from last year. The 10-year yield is a big one too. I talked earlier this week about how there's a multi-year, like 18-month downtrend in the 10-year that was broken. But what I want to focus on firstly is the message of the yield curve, which is still probably the most important thing, because what we're getting in the yield curve is what is the most unique thing happening in the economy right now. Right now, if people ask you on the holiday about finance and markets or the economy, there's one thing you can say to sound really smart, and it's that the yield curve is doing something it's never done when the Fed cuts rates. I don't know if your family's going to be talking about it or not. Mine might be. Here's what's happening is, because I'm going to make them. The swing here for the 10s and the 2s above where we were in the fall. We broke back out to the upside, and then we happened to see more of the general trajectory, which has been bear steepening. The long end yields going up while the Fed's cutting. This doesn't happen. It does now, and that's why we're living in somewhat of unprecedented times. But the message of it, I still think, is a compelling one, and it's a positive one. If you look back on this year and the few times that we sold off, we really only had a couple instances, and you can see it most clearly just by looking at the VIX. VIX is in the blue. This was the Japanese yen volatility, the pop there in the middle, the white being the 10-year yield, so I've still got bonds on here. The big difference is that right now we're getting the pop in VIX, obviously, while yields are going up. In the summer, we had yields coming down, and it was a very different type of sell-off. And now, of course, that preceded the move from the Fed to begin cutting rates, which put the low in for the yield in September. This hugely opposite scenario, both leading to volatility, but of completely different reasons. Here, there was fear about economic headwinds and currency dynamics and general stagflationary themes. This one's back more towards a positive growth message. But again, that still is couched with this caveat of inflation that the Fed has to be wary of. I still maintain that this is really one of the best scenarios you could ask for. At some point, will the economy slow down more? Probably. But trying to time that and continuing to think that recession's around the corner has proved to be a big mistake and one of the biggest stories of the year in this massive turnaround. So even though stocks are down this week, I still maintain it's a good situation that's more about equities getting into a little bit of a bubble and that having to pop and air come out of the extraordinary valuations, some of the rampant speculation that's been happening. And that leads us to the last chart. Of course, what we learned this week, which you probably should have known already, Bitcoin's candle engulfs the previous 2 weeks. That's what happens when you are high risk, high beta. For all the talk about the maturation, the one-time stocks get hit. Bitcoin does worse. And so we learned that it still is what it is, an indication of risk-taking appetite. I will see you for a day next week.